Hey everyone, today we're talking about the debt storm ahead. And what's on our mind is really looking at how the rising US interest payments might affect our portfolios. So I'm Cary Smith and I'm sitting here with Cheri Turner,
Everyone.
and we're both with Client First Capital. And so Cheri, this is such a timely topic because interest payments are going up, and we're also seeing at least potentially some growth in the national debt,
Mhm.
which is which has been going on for quite some time.
Yeah.
And so, but it's important to understand, where we are today, how that might impact our portfolios, so that we can move with purpose
Right.
and intention and be ahead of changes that we might need to make sure that our portfolios are in good shape for this. So why don't you kick us off, and maybe a good place to start would be just the current situation.
Right. So here's the part that should make us all pay attention. It's not just the size of the debt that's alarming, it's the rate that we'll have to pay to keep it going. So if you're an investor or retiree, this shift could quietly reshape everything from bond yields to stock prices to your tax bill. So as of today, the US national debt stands at over $36 trillion. That number is huge, but it becomes even more dangerous when you understand how it's structured. The federal government doesn't borrow in 30-year chunks like a mortgage. Much of our debt is short term, meaning it needs to be rolled over or refinanced every few years. And in 2025 and 2026, there's a massive wave of debt, roughly $9.2 trillion coming due. So that debt was mostly issued back when interest rates were only around 1.5%, or some of it even lower. So today, we're looking at rates closer to 4 to 5%. That means every time we refinance, our interest bill balloons.
So that's such a good point, Cherise. So even though the national debt, although it's forecasted to continue to grow, at least for now, that may not be the bigger problem that's impacting our portfolios. It's just the size of the payments on the existing debt is going to
Exactly.
grow significantly. And if we're going from 1.5% to 4%, that's pretty significant growth, and it's easy to see how that will shape the markets and yields and so forth.
Right.
So okay, so yeah, so let's keep digging into this.
Yeah. So when we look at the costs of refinancing, what happens when trillions of dollars in government debt issued when rates were very low must now be refinanced at rates two, sometimes three times higher? And this isn't just a theoretical problem, this is already happening. The US Treasury has been refinancing billions in short term debt each month at sharply higher interest rates. Unlike a household mortgage with a fixed term, the government continually rolls over its debt, much of it in the form of 1 to 10 year treasuries. As those bonds mature, the Treasury has to issue new ones at the current market interest rates just to keep the wheels turning. So interest payments on the debt are actually exploding. The Congressional Budget Office projects that annual interest payments themselves could exceed $1.6 trillion within the next decade, making it one of the largest federal budget items, possibly even surpassing defense and Medicare spending. So, to put that into perspective, interest alone could soon cost more than the discretionary budget. And that's a massive shift in fiscal priorities. The rise in the debt service expense is already visible. In 2020, the federal government paid about $345 billion in interest on the national debt. By 2024, that number was closer to $880 billion. So the more we refinance, the higher that number climbs. So it's not just accelerating, it's unsustainable. So there's really only three options to address it, and those are to cut spending, raise taxes, or borrow more. So this isn't a future problem, it's a now problem. And if you're not directly involved in policy or government finance, the ripple effects on interest rate, market volatility, tax policy, and public services can and will touch every investor, especially those in or near retirement.
So, Cheri, such good points that you make. And I know that this is factored into your calculations and your thought process, but, also just layering on here is recently and over the last couple of years, rating agencies has lowered, right, the rating of U.S. debt.
Right.
And so, which makes, future borrowing and renewing of loans or this debt even more expensive.
Right. Exactly.
Okay. So what does this mean for investors?
Right. So let's talk about how this affects the watcher directly. First is inflation risk. Persistent deficits mean more money being pumped into the economy, which can stoke inflation, even if it's moderate. That inflation, in turn, pressures the Federal Reserve to keep rates higher for longer, which is not great news for borrowers or for the bond market. Then there's bond price volatility. If rates stay elevated, then existing bond prices remain under pressure, especially for the longer duration bonds. Stocks aren't immune either. Higher interest rates reduce the present value of future earnings, which can drag down equity valuations, especially for growth stocks. And then you can't forget taxes. Rising interest costs could lead to higher taxes in the future. So planning now can really help you avoid some of those surprises later.
Yeah, and you spoke about equities a little bit, and where I thought you were going to go, but you didn't. You made a good point though. Was for small caps and small businesses and medium-sized businesses, access to capital becomes more expensive,
Right.
harder, or maybe even not possible at all. Right,
Exactly.
and so that impacts the equity markets as well, and can impact our portfolios.
Right.
Okay.
Absolutely.
So let's move into, so we've been talking fairly high level. Let's look down into, what does this mean for an individual's portfolio, and what actions might they take or consider taking to, be ahead of this or to prepare for what's coming.
Right. So while we can't control the federal spending or the interest rate policy, we can make intelligent strategic adjustments to our personal financial plans. In an environment where rising interest costs are reshaping the economic landscape, your portfolio needs to be resilient, flexible, and optimized for this uncertainty. So here are 3 key actions that you can take. The first is to diversify smartly, but with intention. Diversification is more than simply owning a mix of stocks and bonds. It's about spreading risk across different asset classes, sectors, and tax treatments in a way that reflects the current economy and supports your goals. Diversification won't eliminate volatility, but it can reduce the impact of any one event, whether it's a market pullback, tax law change, or inflation spike.
So I love that you said, because we always say diversify smartly, but you said, but with intention. And so for me, what comes to mind is all the things that are not with intention. So one of them would be, blindly owning just a little bit of everything in your portfolio, right? And you spoke earlier to what's happening in the economy, what's happening with GDP, what's happening with inflation, all of those things, right, are factors that should be considered when knowing, what to own and where there might be too much risk. Also, it's with intention is not chasing performance trends. I would say that is not with intention. And then also overcomplicating your portfolio with unnecessary assets. And one of the things, and we've spoke about this in the past, but one of the things that just really bothers me when portfolios get unnecessarily overly complicated, it's easy for bad performance to hide in complexity.
Yes.
But if we keep things simple and straightforward, it's harder for that bad performance to hide out somewhere. And so I think the keeping things from being overcomplicated can make help our portfolios perform a little bit better.
Absolutely.
Okay, but I interrupted you. Keep going.
No. So the other thing that you want to do is rethink bond duration and interest rate exposure. So longer duration bonds are more sensitive to interest rate changes. So if rates continue to rise or even remain elevated, those bonds lose value more quickly. So this is particularly dangerous for retirees who may need to sell their fixed income holdings to fund their withdrawals and thereby locking in their losses.
Okay.
Yeah. And then the last thing is to optimize your liquidity and cash reserves. In volatile markets, your more liquid investments, such as your fixed income investments, are not just an idle asset, they're your strategic fuel. So having 12 or more months of living expenses or in portfolio withdrawals in your fixed income investments, high yield money market accounts, or treasury bills can reduce the need to sell investments in a downturn. For retirees, this cash cushion is critical to avoid the sequence of returns risk, which is that danger of drawing down a portfolio during a market decline early in retirement. So a solid liquidity buffer really buys your portfolio that time to recover.
Okay. So Cheri, we talked about a lot of things, and I would say this is not a theoretical conversation of something that could possibly potentially happen at some future point. This is something that actually is happening now as we sit here and speak. And if you realize it or not, it's already having impact on your portfolio. And so, now I would say this is not an environment for passive management. This is a time that people need to be paying attention to the portfolios, actively managing their portfolios, making smart decisions. And I would say, if you would like us at Client First Capital to take a look at your portfolio and share our opinion and changes that maybe you should consider, please reach out to us at clientfirstcap.com. You can schedule an appointment there, and we'd be happy to give you a free financial consultation with someone on our team. But I just want to thank you for watching. Cheri, good job with this content for our video today. If you found this video helpful, please give it a like. It really helps other people find our content. And if you're planning for retirement or just want a second opinion, we'd love to help. Head over to our website, again, at clientfirstcap.com, and you can schedule a free consultation with someone on our team. And don't forget to check out other videos for more retirement planning, insights, tax strategies, and smart investing tips. Cheri, I can't thank you enough for the good topic today. Thank you.
Thank you.